The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I want to begin, as I always do, by saying thank you. Thank you for taking the time to listen, but above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear it enough, but you're always going to hear it here. The other thing that you're always going to hear is my buddy, Ed Zerndorfer. The guru is back with us once again as part of our ongoing mission to reach, teach, and serve you. If you're a regular listener, you like to follow Ed's FedZern articles, which are awesome. You can find those at fed-zone.com. You should give them a read. But that gives us one more way to reach and teach. So today we are talking about IRMAA. And no, that is not someone's favorite aunt. It is the income-related monthly adjustments for Medicare. So, Ed, you begin your article by kind of laying out some Social Security parameters, so tell us about those.
Yes, you'll see the connection here in a moment, Dan. Anyone who's eligible for Social Security, namely they're fully insured, can start receiving their monthly Social Security retirement benefit as early as age 62. That's the earliest they can get it. And they don't have to take it at 62. If they do take it at 62, they're gonna get it. They'll be subject to what's called a permanent reduction. It's not a penalty; it's a reduction. Why is it a reduction? Because the individual is starting their Social Security before what's called their full retirement age. Full retirement age. What is full retirement age? It depends on what year you're born. Most people today who are born after 1937, full retirement age is between age 66 and 67. Yep. I took my Social Security at age 70. My full retirement age is 66. So again, it's something. Again, you could take your Social Security at any age between age 62 and age 70. The closer you are to your full retirement age, the less reduction to your benefit. That's Social Security. Social Security. Now, when it comes to Medicare, that's a different issue. You do not have Medicare enrollment age is age 65. And what are we talking about here when it comes to enrolling in Medicare? Medicare Part A, the hospital insurance, and Medicare Part B, which is called the medical insurance. Now, Medicare Part A, Dan, is free. You do not have to pay a monthly premium for Medicare Part A because the premiums were prepaid. If you're an employee, when you start working, you're paying what's called the Medicare Hospital Insurance Tax, HIT for short. It's equal to 1.45% of your wages, up to no maximum limit matched by your employer. And the rule is, Dan, that if an employee has worked during their entire lifetime and paid the Medicare payroll tax, the hospital insurance tax, for a minimum 10 years, any 10 years, Dan, it doesn't have to be 10 consecutive years. They could have started working when they were a teenager, and then maybe they went into the military because you pay the Medicare payroll tax too. If they paid that payroll tax for a minimum 10 years, that means they're eligible for Medicare at age 65, and there's no monthly premium for Medicare Part A. Medicare Part A, Gotcha. It's free. You prepaid the premiums.
Yep.
And because of that, most individuals, I have no problem signing up for Medicare Part A. Why not? I paid for it. I'm going to enroll in it. On the other hand, Medicare Part B, the medical insurance, is not free. It's not free. I just want to say one more thing. that there's some other individuals who are eligible for Medicare before they're 65, and those individuals who are disabled. If you've been receiving Social Security disability payments for 2 years, after 2 years, you're eligible to sign up for Medicare Part A and Part B. I just wanted to throw that in. So that is not so Medicare. Now Medicare Part A, most people, as I say, do sign up for Medicare Part A when they're 65, even if they're still working. If they're still working, because it's free.
And Ed, you and I are mainstays on our FEHB, Medicare, and TRICARE webinars, so we know how heavy a decision is for most folks about making that decision to sign up for Part B, because you're paying something for it. And now, as you correctly point out with your article, there's another little wrinkle in there, which is those income-related monthly adjustments. So there's actually a tier structure to which you could be paying for Medicare. Let's talk about that a little bit before we dive into how you might be able to set yourself up.
Sure. Now, I just want to make a plug again. I just do this during the course of our podcast about a particular webinar. This webinar is held monthly. It is absolutely crucial that federal employees attend one of these webinars. You could attend it, no matter what your age is, but particularly those employees who are in their 50s, early 60s, who will be enrolling in Medicare within a few years, should attend one of these webinars, because we talk about all the advantages of enrolling in Medicare Part B together, having your federal employee health insurance. And if you're a military retiree and you're getting TRICARE, you have to sign up for Medicare A and B. We're getting back to the subject at hand here. As I said, Medicare Part A, most federal retirees have no problem with that because it's free. But the problem comes in that Medicare Part B, the medical insurance, is not free. You have to pay a monthly premium. And the rule is the higher your income, the more you have to pay for Medicare Part B. And for someone who is getting a nice amount of income in retirement, thank God most federal retirees do it. We're talking about what? A CSRS annuity, a FERS annuity. We're talking about TSP, Social Security, IRAs, you name it. It makes for a wonderful retirement. I'm the first to tell you because I'm a federal retiree. And I know I've been retired now for 18 and a half years. And believe me, ladies and gentlemen, Dan, this is a blessing from heaven, being a federal retiree. But here's the problem. And this is what most federal retirees tell me. I don't need Medicare Part B because I have my federal employee health insurance. And that's not quite true. And we explain why you need it. The problem is, again, you have to pay the Medicare Part B premium. Medicare Part B each year sets the premium rates, and they have what's called a standard rate. For example, during 2024, if you are what's called a Medicare Part B beneficiary, not enrolled beneficiary, your income is below a certain amount, you're paying the standard monthly premium of $174.70 per month. That's the standard monthly premium. For who? If you are single or you follow as head of household, your income has to be below $103,000. That's when I say your income, I'm talking about what is called your modified adjusted gross income. Modified adjusted gross income.
Yep. Which
for most people is their adjusted gross income. And if you're married filing jointly, you and your spouse's adjusted gross income, modified adjusted gross income, has to be below $206,000. For this year, those modified adjusted gross income limits apply to what occurred during 2022. There's always a 2-year look back. All right.
Gotcha.
Now, here's what you have to be aware of. If you go over by $1, your income, you're being pushed into what is called the next income tier. So what I'm saying is, if you are a single person this year and you're enrolled in a Medicare Part B beneficiary, and during 2022, your adjusted gross income, modified adjusted gross income, was $103,001. Married filing jointly, your modified adjusted gross income, you and your spouses, was $206,001. you're going to be pushed into what's called the next income tier, and you're going to pay an income-related monthly adjusted amount of $69.90. You're going to add that to the $174.70 standard Medicare Part B premium. Now, every year, Medicare adjusts those income tiers. They usually go up a little bit, and so do the monthly premiums.
Sure.
So this is what you have to keep in mind there. And this is what I always tell people. You're complaining about that Medicare Part B premium, but please realize that only represents 25%. 25% of what the real Medicare Part B premium cost is. The federal government is paying the other 75%. The 25%
Gotcha.
This year, $174.70 per month, goes up if your income goes up. For example, if you're in the next income tier, paying that extra $69.90, now you're paying 35% of the premiums, and the government's paying the other 65%. You go up to the next income tier, you're up to 45%. It's going up. It's going up.
Sure.
Until the last income tier. I know some people who are in that last income tier. We're talking about, Dan, modified adjusted gross income for singles over $500,000, married filing jointly over $750,000. They are in the highest income tier, and they pay the maximum amount of IRMAA. So
Gotcha.
the question is, what can we do as Medicare Part B beneficiaries to maybe do something to cut down that IRMAA? Is there anything we could be doing?
Ed,
well,
tell us, is there anything? Is there anything we could do, Ed, or are we just sunk?
No, there's always a way. And the financial planners, and that includes myself, we're always looking for ways to help people. And this is one of the things we're trying to do. Help Medicare Part B beneficiaries pay the least amount possible for Medicare Part B. It won't be subject to IRMAA. I will tell you, Dan, it takes a lot of planning, and it's not going to be overnight. Ideally, the planning for your minimizing your Medicare Part B premiums should start maybe in your 40s, as early as then. And we're going to talk about suggestions about what they can do. Maybe even your 30s. Get into your 50s, you got to get serious. By the time you reach your early 60s, you got to do it, or else you're going to end up being stuck with those IRMAAs. Sure.
And, Ed, I don't want to pull out a crystal ball here or anything, but, we have seen where postal employees are basically being shepherded over into Medicare. It is not beyond the realm of possibility, in my opinion, that could be the case for all feds someday. So if you're sitting there as a 45-year-old saying, I don't have to worry about this for years and years and years, and anyway, nothing says I have to take it or that type of thing, may or may not be the case. So a lot of things that Ed's going to talk about are good planning practices anyway. So, Ed, you have some ideas that our feds can do to reduce modified adjusted gross income. What are they? Take us through them.
All right, let's start with the first one. Roth IRA conversions. Roth IRA conversions.
Love them.
If you have a traditional IRA, a sizable amount of a traditional IRA, understand that all the growth in that IRA has been tax deferred. And Washington is waiting for you to take the money out because they are looking for your tax dollars. When you take money out of a traditional IRA, let's say it was a deductible IRA, or you rolled over money from a qualified retirement plan into a traditional IRA, everything coming out of there is taxable, which means it's going to add to your adjusted gross income, meaning when you are enrolled in Medicare Part B, determining what you're going to be paying, that the money that was taken out of that IRA could, in fact, push you into a higher IRA. So how do you get around that? You get around that by converting your traditional IRAs to Roth IRAs, traditional IRAs. Ideally, you'll start doing that before you reach age 65. Because here's the problem. If you start after 65, you're enrolled in Medicare Part B. Now you're starting to convert your traditional IRAs. Guess what? Converting traditional IRAs adds to your income. You're going to end up paying more Medicare Part B for the year that you did those conversions. So ideally, you'll start these conversions. You start these conversions before you turn 65, maybe in your 50s, 40s. And this way, you'll pay the tax on the conversion. And then down the line, you'll have a Roth IRA. There's so many positive things to a Roth IRA. You don't have to take the money out, but if you do, it's not going to be included in your income. Also, when it comes to your traditional TSP, federal employees have a traditional TSP account. Many federal employees have a lot of money in their traditional TSP. Look what's happened over the last couple of years. They've skyrocketed. To have a traditional IRA, I was talking to somebody yesterday. They just retired. They have $1.5 million in their traditional TSP. They're 65 years old. They're about to roll Medicare Part B. So I said to her, it's a shame you didn't contact me earlier, a couple of years earlier, because when you reach 59 and a half, when it comes to the traditional TSP, you are allowed to make in-service withdrawals from your traditional TSP, even though you're still an employee. And what you would do is you would transfer. This is not a withdrawal. It's a rollover. You could transfer your traditional TSP to a traditional IRA and convert the traditional IRA to a Roth IRA. This way you'll get the money out of your traditional TSP, because everything out of your traditional TSP, everything is going to be fully taxed. And a person said to me, well, I'm not worried about it because I don't have to start taking money out of my traditional TSP until I'm 73. That's my required beginning date. Here's the problem. If you wait that long, your traditional TSP is going to build up and your requirement of distributions are going to skyrocket. Every year, you're going to have it earned. You got to do some planning. Here. So that's the first thing, Roth IRA conversions. Next
and you're second one a lot of folks might not think about, and that's the healthcare savings account.
Yeah, I love HSAs, Dan. I think they're fantastic. And there are a lot of positives to them. One of the positives is that money going in is tax deductible. That is, money you contribute to your HSA is deductible. The HSA accrues earnings, not like a healthcare flexible spending account. You can invest it like an IRA. But here is the beauty of the HSA. All money coming out of the HSA, to pay for medical, dental, vision expenses is tax-free. What's this got to do with Medicare Part B? Because many of the medical expenses of a retiree over age 65 may not be covered by Medicare, may not be covered by your health insurance. Here, you pull the money out of your HSA, tax-free, to pay those expenses. It will not be included in your income. It will not affect your Medicare Part B premium. Now, keep in mind that the only time you can contribute to an HSA is before you sign up for Medicare Part A. Medicare. You cannot contribute once you're enrolled in Medicare, that is signing up for Medicare, even Medicare, just Medicare Part A. If you have an HSA, you can't put any more money into it. And that's why I suggest that federal employees, if they're going to continue in federal service past age 65 and they have an HSA, don't sign up for Medicare Part A. You know you can, but don't. Because the minute you do, you stop putting money in that HSA.
Gotcha.
So the HSAs can really, really cut down, money coming out is tax free and pay those expenses. It could really help minimize those Medicare Part B monthly premiums. Remember, Dan, it only takes $1 to get pushed into the next income tier and be subject to IRMAA.
$1 leads to ouch. Okay. Now, Ed, I love your next two, and they're ones that a lot of folks just might not be familiar with. And first up is making use of qualified charitable distributions. Philanthropic giving is big with our firm and our planning. So tell us about that.
Dan, there's another thing I love is qualified charitable distributions. I love HSAs. Yep. I love qualified charitable distributions. And talking about QC, what is a qualified charitable distribution? If an individual is over age 70 and a half, that's the rule, and they own a traditional IRA, they can request that the IRA custodian make a direct contribution to a qualified charity. What's a qualified charity? A church, a synagogue, a mosque. It could be the Goodwill. I'm sure there's no lack of qualified charitable organizations. And what are they accomplishing? The money that is the money coming out of that traditional IRA is being distributed by the IRA custodian, is sent directly to the charity, and the money coming out, which normally would be taxable to the IRA owner, is not taxable. It is so good because once that IRA custodian reaches their required beginning date, now 73, they can use this QCD to fulfill their R&D. Remember that traditional IRA R&D is included in your income normally. Is normally included in your income. Thereby, it could affect your Medicare Part B premium. If it's not including your income via the QCD, then it's not going to affect you're not going to affect your income because it's not including your income. At the same time, you can't have your cake and eat it too. You can't turn around and say, I'm now going to itemize that deduction. You can't do that. You got to be very careful about those QCDs because you could end up losing the benefit if you don't do it the right way. And I'm going to direct our listeners to a FedZone column I wrote. Just go to the FedZone on the hazards of QCDs, how to do it right. All you got to do is to go to www.fed-zone.com. Under the search engine, put Qualified Charitable Distribution, and you'll see a lot of information there. How much can you make as a qualified charitable distribution? Congress in the Secure Act 2.0 increased it. This year, it's $105,000. Now you say, well, nice. That's a nice amount of money, but my R&D won't come close to that. My R&D might be $30,000, $50,000. I understand that. However, understand also that if each year after age 7.5, you're making a QCD from an IRA, okay, that's cutting down the size of your IRA, which means in future years the IRA R&D is going to be less. But also keep in mind, you cannot use your a QCD on your traditional TSP. All QCDs have to be made from a traditional IRA. So how does that affect TSP participants? Here you have a traditional TSP, and you're over 70.5. Well, you are allowed to each year do a direct rollover of your traditional TSP to a traditional IRA. So the plan is that starting when you're 70.5, start doing direct rollovers, requesting direct rollovers of your traditional TSP to a traditional IRA. That means the money is leaving the traditional TSP. That will cut down your R&D for the traditional TSP. You have an R&D for the traditional TSP and an R&D for traditional IRA. They're two separate ones. By rolling some of that money over to traditional IRA each year, you're cutting down the balance in your TSP so that the next year your TSP R&D will be less. And as far as the traditional IRA R&D is concerned, you can use the QCD to eliminate it. You won't have to make a traditional IRA R&D when you reach your required beginning date by using this strategy. So it's a win-win-win situation, in my opinion.
No, it sounds like it. And your last one, again, a lot of folks might not know about it. And you talk about utilizing a qualified longevity annuity contract. Tell us about that.
Yeah. With a qualified longevity annuity contract, an individual it could be any age, would transfer a part of their qualified retirement plan, and that includes the TSP. And where would they transfer it to? Traditional IRA. And from the traditional IRA, they can request to set up from a custodian, from a IRA, like an annuity company, something called a qualified annuity contract. in which, under IRS rules, the individual would not have to take any money out of it, including RMD, until they reach age 85. In other words, that money that comes from your TSP goes to the IRA, then in turn, it goes to the qualified longevity annuity contract, is not going to be included in the RMD calculation, both for the TSP and for the IRA, until age 85. At that point, they got to start taking money out. If your RMD is age 73, that gives you 12 years of reduced RMDs. And again, you still can use the strategy of the qualified charitable distribution together with this. So all in all, this is going to reduce the balance in your TSP, which in turn will reduce your RMD to TSP, and then using the QCD on the IRA as well as the QLAC will cut down the amount of your QCD on the IRA. It's a win-win-win situation. There's a Fed Zone column that was written, I think, about a year ago, where I talked about putting all these strategies together. I know we talked about that on one of our podcasts, and listeners should check out that Fed Zone column, because we had a podcast on it. Ladies and gentlemen, there are ways that you can minimize that IRMAA, but you got it. It really takes a lot of planning. You should work with a qualified advisor. Again, I know we've talked about this many times at Serving Those Who Serve during our webinars about strategies to, in terms of, you don't have to pay the maximum amount of taxes because your RMD is so high. Your things you can do to cut down that RMD.
Absolutely.
And in turn, cut down the amount of your earnings. That's what we're talking about today.
Indeed. Ed, once again, a great and timely article, stuff that people just aren't finding out there. And Ed's right, folks. Don't be a stranger to our website. I'm going to say make it your homepage, because there are years upon years upon years of evergreen information in there for you for how you can make the best decisions about your FedLife, your money, everything. So make use of it. Once again, Ed, a great and timely article. As I say all the time, on behalf of all the Feds, I want to thank you for being such a great resource.
My pleasure, Dan. It's always a pleasure.
Well, folks, that's a wrap. We are Serving Those Who Serve. Be sure to hit that subscribe button and subscribe to this podcast on YouTube and Spotify. Please share with your friends and strangers. Don't forget our live webinars every single week. Just go to stwserve.com. You'll see the blue webinar button. Hover over it, turns red, click it. Bam, you get our whole menu there. And that means the guru comes to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. You will be happy. Share with your friends. They will thank you. Again, be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Please, please, please make it a great one, because you deserve it. Stay well, everybody. We are out.